talking about the ECAP, the Internal Capital Adequacy Assessment Process, also known as ECAP or ICAP. If you're working in the banking sector, you're working in risk management, you're working in modeling, or you're working as a quant, I think this video will be useful for you. So you can listen to it, and you can also ask me questions in the description section if you have any. So let's get into it. So what is ECAP? Well, I've already said what it stands for. It's Internal Capital Adequacy Assessment Process. So as the name suggests, it's about assessing capital adequacy, but there are nuances of it as to what it entails. How is it different from the more regulatory capital assessment? What exactly are the methodologies used? How the methodologies are different from the what are used in regulatory capital assessment? Are there similar methodology for other risk types, for example, for liquidity risk type? So we will discuss all of this in this video. So ICAP was introduced as part of Basel II. It's also known as the Pillar 2 assessment, wherein the bank is supposed to perform some of the internal assessment. So these are less stringent, so to say, for the bank to follow, whereas the regulatory capital assessment comes under the Pillar 1, which is, that means the importance is higher, and these are stricter requirements compared to the Pillar 2. ICAP comes under Pillar 2. So what the regulators expect is that there must be some internal capital assessment within the bank to ensure that the bank has got enough capital to withstand all kinds of material risk, by the way, not just credit risk but all kinds of risk, and to ensure that the bank has enough capital beyond the minimum regulatory capital. So that's quite important. That means the regulatory capital is the bare minimum, but what regulators expect is that the bank should also assess if in case there are risks which the regulatory capital is not able to cover. So that should also be part of this assessment. So roughly speaking, your capital assessment on ECAP is broader in that sense compared to the regulatory capital assessment, and it also takes into account the stressed and worst scenario, so which is also quite an important thing. That means the bank has to assess the different scenarios, stress scenarios, adverse scenarios, severely adverse scenarios, and see whether it has got enough capital or not. And ECAP is also used for benchmarking by the regulators. So the ECAP capital figures are also used to compare level of capital among the participating bank. In Europe, in European Union, the ECB does it. In other jurisdictions, you have the you have the regulators. For example, in the UK, you have the Bank of England. Obviously, in all countries, you have regulators, banking regulators. What are the things that are done as part of the ECAP exercise? So it's, as I said, it's an internal exercise. So the banks have got more freedom in terms of the assessment, in terms of deciding on the scope, in terms of what methodology to use, in terms of coming up with the future scenarios, in terms of assessing the growth aspect of the business, all of this model strategy, everything, business strategy. So there's greater freedom to assess these aspects compared to the more regulatory capital assessment, wherein there are set guidelines given by the regulators. ECAP specific information covering design and main features of ECAP methodology. That means you have also more flexibility when it comes to choosing ECAP methodology. And then there is also something similar on the liquidity risk side, which is known as ILAP. So this is more to do with liquidity and funding risk management framework, and very similar to what is there in ECAP, but it's only for liquidity risk part. It stands for the internal liquidity adequacy assessment process, in short known as ECAP, to ensure that the institutions maintain adequate levels of liquidity buffers and adequate funding. Important to note is liquidity buffers. That means enough capital, enough liquidity, and you have enough funding in case you need liquidity in very short notice. Banks must have enough number of options to get funding, external funding or funding from customers, depositors, so on and so forth. And the methodology for managing and monitoring of this funding position must include the current and projected material cash flows. Liquidity, if you have worked with liquidity risk management, must be knowing that liquidity risk is more to do with assessing the future cash flows, both inward and outward, and the projected material cash flows from various assets and liabilities or other balance sheet items. So those things should be covered in ILAP, which is similar to ICAP but only covers the liquidity part. Then about assessment criteria as to how and the bank should assess and how they should disclose the assessment to the regulators. This should be consistent with the risk profile and operating environment of the institution. Risk profile could differ with respect to the bank. Some banks are more aggressive in their business practices, others are less aggressive, so it has to be in line with the risk appetite of the bank, and therefore it is tailored to the institution's circumstances and needs, and these circumstances and needs could differ across the banks. So these are more bespoke or more specific aspects of the bank and cannot be generalized, which is also a difference between the regulatory or the own fund requirement methodology, wherein banks, the guidelines are more generic in sense. They are more general, applied to all kinds of banks regardless of the situation, circumstances, needs, or the risk appetite of the bank, whereas ICAP and ILAP are more tailored made for the given circumstances of the bank. Okay, so that's one other difference between regulatory capital and the assessment in ICAP and ILAP. The institution should make ICAP and ILAP understandable to the competent authorities and demonstrate that they are sound and effective and comprehensive. Now, when you have flexibility, one big challenge for regulators is that the banks could potentially use sort of any methodology, but the competent authority, in this case regulators, should also be able to understand this methodology. So the bank should ensure that the methodology are so clearly written down that the regulators can understand them, because unlike the more regulatory capital assessment, wherein the methodology are set out by the regulators themselves, here in this case there's greater flexibility for the bank, and banks could use just about any methodology, and it's probably quite difficult for the regulator to assess the methodology used. Hence there is greater emphasis on simplicity, but also about understandability, as in the regulator should be able to understand what this. There is a lot of freedom, but with the requirement that the methodology should be understandable. It should not be too complex. The design of ECAP and ICAP frameworks is the responsibility of the institution. That means, again, it's the institution that is responsible for what framework to use. So you could see a variability there. That means because of the freedom that is available to the banks, you have variability, as in you look at the ILAP or ICAP framework for two banks, you could find them quite different. That could happen. And these frameworks would contain both qualitative as well as quantitative elements, which is similar to other risks. Even for pillar 1 capital assessment, you have both quantitative as well as qualitative assessment. So it goes without saying that this assessment, ILAP and ICAP, also entail that. ILAP and ICAP should be risk-based, covering all material risks which the institution is or might be exposed to, and consider also the regulatory and economic business environment in which the institution operates. What is important to note here is that the regulators also put emphasis on the economic and business environment, which is a bit different from the regulatory capital side, whereas you are not supposed to use the macroeconomic variables, for example, in building advanced IRB models, because the variability in own fund requirement is something that is not a good thing. So you have at least a bit more stable outlook on the regulatory capital side. Just for stability, sake of stability, that's a requirement there. Whereas for ILAP and ICAP, you have greater freedom to assess or take into account the macroeconomic scenarios and the variability in the macroeconomic scenarios. That's one other difference, by the way. The ECAP and ILAP should be forward-looking, which is more like your IFRS 9 type. An institution should have an internal strategy for maintaining adequate level of capital and liquidity, taking into account strategic plans and how they relate to macroeconomic factors. Strategic plans means how you see the business growing in the next few years, right? That you do not take into account in your regulatory capital assessment, for example. But here in this case, you need to do that. I mean, the banks need to do that. If certain business is going to grow quite rapidly in the next few years, that has to be considered in the assessment. Okay. And also regarding the macroeconomic scenarios or factors, if the bank is expecting, a recession type scenario in the near future, that has to be taken into account in the assessment. ECAP should produce a reasonable overall capital number and assessment, and I think it should not be lower than your regulatory capital. So regulatory capital is the bare minimum capital the bank needs to hold, and then you sort of have to compare that with your ILAP assessment and the capital you allocate in this particular assessment. The institution should be able to explain to the competent authority the calculation methodology, which I have already discussed, to make ECAP understandable, and the similarities and differences between ILAP and its own funds requirements. Own fund requirements is the regulatory capital. That means the bank should be able to explain the differences between the assessment, capital assessment as part of ECAP process, and which is the pillar 2, and the own fund requirement, which is the regulatory capital or pillar 1 capital. So that difference should be clear to the regulators, and how sort of the methodology used by the bank to arrive at those numbers should be very clear to the regulators. On business model and strategy, competent authorities should ensure that they receive from the institution description of the current business models, include identification of core business line, market and geographies, and subsidiaries and products. Now these things are not required as part of the pillar 1 capital assessment, wherein banks are not supposed to provide too much of details about what are the core business lines, what markets we are operating in, what geographies we are present in, and what the subsidies are of the. But these details are super important in pillar 2 assessment. So in a way, the scope is actually wider in Pillar 2 assessment or in ELAP, ECAP compared to the Pillar 1 regulatory part. Although the guidelines are a lot more stricter for Pillar 1. And also on the description of the main income and cost driver. So, it's quite obvious that the regulators would like to know the sources of the income and the cost for the given bank, and how they are allocated to different core business line, markets and subsidiaries and so on. So, this assessment is much more granular in that sense. So this is a lot more detail. If you actually see the Pillar 2 reporting for the banks, you will see more bullet points, right? More sections and subsections and so on. Unlike the more regulatory capital assessment, where regulators are only worried about what is the overall level of capital, the CET1 ratio, and etc. in Pillar 1 disclosure. On forward-looking strategy, competent authority, which is regulators, should ensure that they receive from the institution as in the current business model and the underlying activities, and how they see that to change over in the future, and projection of key financial metrics of all core business lines and markets and subsidiaries, and description of how the business strategy are linked to this exercise, ILAP and ICAP exercise. So forward-looking means about knowing about the future, and I think within every bank you have a strategy department that is given this task to assess the future strategy of the different business unit, the growth prospects. The bank could ramp up the business in certain geography, in certain market, in certain business areas, or ramp down, and that has to be very clear actually in this assessment, and the assessment should take into account these potential changes in the future. Hence the word forward-looking has been used here. Then you have risk appetite framework. It is there on all kinds of risk, and there are more guidelines. So this screenshot I've taken from the ECB document, but yeah, these are very generic guideline. Nothing very different from what I've seen from other sort of regulatory document. So I won't spend much time here. Then you have stress testing framework and programs. Stress testing is important in this case because remember in the first slide itself I just mentioned to you that you also need to have the different scenarios, the worst case scenarios, and stress testing is very important therefore, because in stress testing you actually evaluate your capital. You assess whether the capital is good enough for different scenarios, right? Baseline, adverse, and severely adverse scenario, and so they're interrelated. A general description of institution stress testing program, including inter alia the type of stress test undertaken, their frequency and methodological details. So the stress testing department should provide details about what stress tests have been undertaken, what's the frequency, and what methodology have been used, and how they're related to how they use for ILAP and ICAP process purposes, right? These are also used for IFRS 9, for example, right? But also useful for ICAP and ILAP. And are also not just for ICAP but also for ILAP, so that's also important to note here. And then the use of stress testing and its integration into the risk management and control framework. So you have the control department within each and every bank, how stress testing scenario have been used in the control management and control framework within the bank. So those details have to be shared with the regulators in this as part of this exercise, by the way. Bit more on the methodologies. Internal capital definition and the capital allocation used within the ICAP. Competent authorities should ensure that they receive from the institution the following: the ICAP capital estimates, including all capital elements and instruments considered. The main difference between internal capital elements, instrument, regulatory own fund requirement, and description about methodologies, allocation of internal capital to group entities, core business line. Well, these things we have already discussed actually, and the monitoring process, which is that first of all, disclosure on capital estimates and how the capital estimate as part of ICAP is different from the Pillar 1 capital estimate with the regulatory capital, and that clarity should be given to the regulators, and how capital is allocated to different group entities within the bank, whether it's core business lines, whether markets, right? And then you have whether there is a monitoring process in place to monitor these things on a regular basis. Yeah, we mentioned about adverse scenario. I think that's very important to understand why there is this pillar 2 requirement is because there may be certain aspects of risk that that can be overlooked in the assessment of Pillar 1 capital, and banks may have the knowledge of it. The people working with the bank, senior management, may have the knowledge of it, but because of the strict guidelines, they may not be able to take all of these additional risks into account in the Pillar 1 assessment. Hence this requirement, and hence the need for assessing the adverse scenarios and all of these. So first of all, the adverse scenario should be considered in ICAP, and all the assumption in the scenarios, in assessing the scenarios, should also be properly disclosed to regulators. And here you see the key macroeconomic variables, including the description of how reverse stress tests have been used to calibrate the severity of scenario. So the methodology of stress testing is very, very important for ILAP and ICAP assessment. So that is an integral part of this particular exercise. And then description of key assumption used in the scenarios considered, including management actions, business assumptions regarding balance sheet, reference stage, and time horizon. So yeah, it could have a short-term impact, it could have a medium-term and long-term impact. What management actions are expected to be taken in adverse scenarios if something bad happens. So these are more qualitative assessments, and the banks have got enough flexibility to write about these scenarios. You may not have the numbers, but you should have a storyline to explain the assumptions taken, what actions could be potentially be taken in these scenarios. So all these qualitative aspects also should be disclosed, or as part of this exercise.